Imagine being offered a deal where you invest a small amount of money today, and without adding anything extraordinary, it multiplies steadily over decades into a figure far larger than your original contribution. Most people nod politely at this idea, yet very few truly internalize what it means. Compound interest is often described as the eighth wonder of the world, but the real obstacle is not mathematical complexity. The real obstacle is psychological resistance. Your brain is not wired to appreciate slow, exponential growth. It is wired for immediacy, certainty, and visible progress. That mismatch quietly shapes financial outcomes more than income level or intelligence ever could. To understand this, we need to look at how the human mind evaluates reward. Behavioral economics shows that people heavily discount the future, a bias known as temporal discounting. A dollar today feels more valuable than a dollar tomorrow, even when tomorrow's dollar is objectively worth more. This made sense in ancestral environments where survival depended on immediate resource use. Food stored for later could spoil, opportunities could vanish, and uncertainty was high. Acting now often meant staying alive. The problem is that modern financial systems reward patience in ways our instincts do not intuitively grasp. When you invest and allow returns to compound, the first few years feel almost meaningless because growth appears small and linear. The curve is technically exponential, but visually unimpressive at the beginning. Your brain interprets this as stagnation. Consider a simple mathematical illustration. If someone invests $10,000 at an average annual return of 7% and leaves it untouched, the first year adds $700. The second year adds slightly more because returns now apply to a larger base. After 5 years, the balance is meaningful but not dramatic. However, after 20 or 30 years, the growth accelerates in a way that feels disproportionate to the early years. The key driver is not additional effort, but time interacting with percentage growth. The compounding effect becomes dominant only after patience has already been tested repeatedly. Psychologically, that delay is uncomfortable. Humans prefer visible cause and effect. When effort does not produce immediate, noticeable reward, motivation declines. There's also the issue of scale perception. Our intuition is linear. If you double your savings rate, you expect roughly double the result. Exponential systems do not behave that way. Small differences in rate of return or time horizon create large differences in final outcome. Extending an investment timeline by just 5 years can increase the end value dramatically. Yet emotionally, it feels like a minor extension. Because the early years show minimal acceleration, many people interrupt the process. They withdraw funds, chase higher returns, or abandon the strategy entirely, resetting the compounding cycle before it has matured. In effect, impatience taxes the future. Market volatility compounds the psychological challenge. When prices decline temporarily, the mathematical engine of compounding is still intact, yet emotionally it feels broken. Loss aversion, another well-documented bias, causes the pain of short-term declines to outweigh the abstract satisfaction of long-term growth. This leads to selling during downturns and re-entering after recoveries, which disrupts the continuous growth required for compounding to function optimally. The irony is that volatility, when approached systematically, can enhance long-term returns through disciplined reinvestment, but only if the investor resists emotional impulses. There is also an identity component. Compound interest rewards consistency more than brilliance. It does not require predicting every market movement. It requires a steady allocation, periodic contributions, and the restraint to avoid constant interference. For many people, this feels passive and unsatisfying. We are culturally conditioned to associate wealth with dramatic decisions, bold moves, or sudden breakthroughs. Compounding is quiet. It is procedural. It feels almost boring. Yet mathematically, it is one of the most powerful mechanisms in finance. The discomfort comes from the gap between what feels impactful and what statistically drives long-term wealth accumulation. If we zoom out historically, large endowments, pension funds, and multi-generational portfolios rely on this principle. They prioritize time horizon and disciplined reinvestment over excitement. The system works because it aligns with exponential mathematics, not because it generates constant emotional reinforcement. The individuals who benefit most are often those who structure their environment to minimize temptation, automate contributions, and measure progress in decades rather than months. They are not necessarily more optimistic, they are often more system-oriented. Ultimately, your brain resists compound interest because it evolved for immediacy, while wealth accumulation operates on delay. Recognizing this mismatch is not about forcing yourself to feel differently. It is about designing financial behavior that compensates for human bias. When you understand that impatience, overreaction, and the craving for visible progress are natural responses rather than personal failures, you can build structures that protect long-term growth from short-term emotion. Compound interest is not difficult mathematically. It is difficult psychologically. The difference between understanding the formula and living by it is the difference between knowing the system and aligning with it.